Hello, good morning, traders. I invite you to my live scalping session on the XM site, and also you can see us on YouTube, on the XM YouTube channel. So you can choose which way you will watch my session. But remember that the YouTube channel can be a bit shorter because normally our daily sessions are on the XM website, available on the XM website. Good. Today, my session is called Monday Scalping. Why Monday Scalping? Why scalping on Monday? Well, probably those who watch markets already found it that on Mondays, market are a bit, let's say, call it sleepy. The markets are not so volatile like in the middle of the week. Maybe because after 2 days of holidays, market is still not, the traders, the investors are not sure about the directions. This week is a special week. On Wednesday, we will have the Fed interest rate and monetary policy decisions. So we can expect that coming 2 days or even 3 days before we don't see the decision could be a bit choppy, not directional. We know that the decision of Fed on Wednesday will have big influence on the markets. Market are expecting 25 basic points cuts on Wednesday, but also there's a small part of the market expecting 50 basic points cuts. So it's very interesting what will happen on Wednesday, and be sure that this will have big impact on all dollar pairs, also on some um, minerals, metals, and generally speaking, the whole financial world must be prepared for some extra volatility on Wednesday evening. But before that, probably the 2 days will be very good for scalping. When are the days good for scalping? When market is choppy, when market is ranging, then scalping might be the best way to make some pips because we can trade both sides. We can buy, we can sell. We mustn't pay so much attention to the trends. But if there is a trend, of course, it's also very good for scalping because then we go with the trend and then the results are even better. So, what kind of strategy I'm using when I'm scalping? I'm mostly using a strategy based on MACD. This is an indicator which is very popular. You can use it in many ways. The way I'm using is very simple. I'm trying to catch the moments when price is hitting a maximum or a minimum of the day, and in the same time, MACD is also in the highest or lowest level of the day. What I'm using when I'm scalping mainly on 5 minutes up to 1 hour chart. I'm using a double color MACD. Why double color? I will, of course, explain in a moment. Also, I'm using an indicator which is showing supply and demand zones, but it's available only on a PC, on the Windows system. I don't have this indicator for Android devices, so generally I believe that scalping you need to be very quick, and scalping on a smartphone, I think it's not the best choice. But of course, it's up to you what kind of device you will use when you are a scalper. So I will explain in few words what is the MACD. I will show you these indicators, which is drawing supply and demand zones, and then we'll go to the main idea of the strategy. I will explain the steps you need to do before opening a trade. So as I mentioned, the MACD is really a fundamental element of the strategy. That's why let's spend a few minutes on the MACD. What is MACD? MACD is an indicator which was constructed by Mr. Gerard Appel in 1979. So believe me, this was a very interesting tool. Not only that because it's so old and it survived all the changes on the market and it's still being used, but also because it was invented when we still didn't use candlesticks. We didn't use the Japanese candlestick charts. We were trading on simple line charts. So it's very interesting that after Mr. Apple started using the candlesticks charts and this indicator, we found it very, very helpful in our to make a good decision. There's hundreds of or thousands of ways you can use MACD. I will show you how I'm using. This is a chart of a MACD. Those blue bars here are showing each bar represents one candle. So it looks like this. The value of MACD is the size of the bar. How is the bar calculated? Well, it's a very simple way. It looks maybe a bit sophisticated, but the truth is that the distance between two moving averages is this is what you see at the bottom here. The question is what the moving averages there are. Well, those are two moving averages. One is the blue. In this case, it's exponential moving average 26 period and exponential moving average 12 period. And the distance between those two moving averages, the value, the difference in value between one and the second moving average, it is this bar here. So as you see, very simple, just calculation, just finding the difference between two moving averages. And of course, when the moving averages are crossing each other, then the value is null. What's important that as you see, the original MACD is not changing. The colors, the one I'm using is changing the colors. The change of the color has nothing to do with the value because the values are absolutely the same like the original MACD, but it's very helpful to see the moment when MACD starts to fall or starts to grow. This is the moment when you see the change of the color. But the values, as you see, this is the original, this is the one I'm using. The values are the same. It's only a matter of informing us that MACD just changed the direction, started falling or started growing. How I'm using this MACD? Well, I'm using MACD in my strategy, checking the moments when MACD is turning to bearish or bullish. But also MACD is very nicely showing divergences. Divergence is a situation when price is moving in a different direction than the indicator. So let's say it's such a situation that price goes up, indicator goes down, it could signal that there will be some changes on the market very soon, that maybe this bullish swing will be coming to an end. For an example, here you can see price is creating higher highs and MACD is creating lower highs. This is a signal that there's a divergence. It means that something is not going normally. It usually shows us that a market is close to be exhausted and will start falling. And the moment when it starts, when it begins, this is the moment when MACD turns to bearish. So if I find such a situation, I'm very interested to trade it. Maybe there will be a good setup. The same, of course, is when we have a divergence which is signaling growth. It means that price is creating lower highs like this and lower lows, and then MACD starts to grow, it's usually a signal that price will start creating higher highs and higher lows. So you can see this is the way market is moving like this, like this, like this, and then starts growing, initiating a new swing. And the moment is when you see the MACD turning to bullish, creating a bullish divergence. So in my strategy, the MACD is really very important, and the rules are very simple. What you need to do is wait for the moment when price is creating the maximum, and the second created the maximum. When it's closing, it's changing the MACD to bearish. This is a signal for us to sell. And of course, it works both directions. It's also works when the market is gonna starts to grow. So this is a sample. When MACD stops falling, starts growing, price creates a minimum, and the second, in this case, second candle from the bottom, makes a change, creates a green bar, which means that MACD starts growing. And this is a very good signal to start buying. Of course, we need some experience when we are using MACD. Not each change of the MACD will give us a good signal. It's very important when the change happens. Whereas the game changer, if the candle is too far away from the top, if you count the candles and you say, oh, this is the candle which is creating a top, another bearish, another bearish, and you say, oh, now they changed to bearish, I will start selling. And this might not work, because for us, the most important candles are when they are changing the MACD and they are also making a maximum, not when it's third, fourth candle, because then it's always a chance that we are too late. I see more people on the chat now. I see Kevin. Hello, Kevin. Hello, Ioannis. Hello, Joel. Nice to see you guys. In a moment, we'll go to the charts and we'll start practicing on the charts. Just one more sample. How a normal chart, one of many which we can find every day. And here you can see setups and bad setups. So a good setup is when price is on the maximum of the day. And MACD also was on a maximum here, but then it creates a lower maximum, which means that the market created a divergence. We have a divergence showing MACD lower, creating lower highs, and price was growing. So this moment when MACD goes bearish, and it was also a maximum of the day, it's a very good entry. Here you have a entry where you had a bullish MACD at the lowest level of the day. Another very good entry. And then comes an entry which is not a perfect one here, because you can see that those declines were very, very short. They were not big. I'll make a picture a bit bigger. Because what happens here is usually, I call it a fake signal, because first thing is, this is not a maximum of the day, because here was a higher level. So there's always a risk that those declines might be not big. And why this is a better signal? If we see that MACD is not able to go below the zero line, but it starts turning so bullish over the zero line, usually it's a signal that the buyers, the bulls,